seen investors move from the momentum trade into areas like value. So could Nvidia results change or cement the rotation? Joining us now with more, we've got Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. Jeff, great to chat with you. Talk to me about the momentum trade sort of stalling out as investors shift over from growth to value. How cemented is that trade in your view?
I don't think it's extremely cemented. And I think also for context, it's interesting when you say that the mega cap tech stocks are the most underowned. You have to keep in mind that they now represent some of those holdings in the S&P 500, which has become so uber concentrated. They represent 7, 8, 9% position sizes. And so, back when I started in this industry 40 years ago, if a single holding in a diversified portfolio was in excess of 5%, you were considered reckless. So they're still heavily owned and they represent more than a third of the S&P 500. I think it's probably smart to under-own them relative to the index. That's part of active management. But to answer your question, we have noticed that if you look at what is working so far this year, because of all of the violent pace of news flow, whether it's tariffs or deportation strategies or government shutdown or whatever it is, it's spooking people. And if you look at the charts, it's healthcare, staples, these defensive areas that you're seeing rotation into and that are outperforming. And after lagging for some time, I think that could be sustainable, but I think it's premature. We are ever so gingerly taking the foot off the pedal just a little bit and recognizing that some of these defensive stocks represent very good value and you might want to nibble just a little bit.
Jeff, I guess for investors that are trying to figure out whether or not that some of the buying action that we have seen in those that have underperformed the more defensive plays, whether or not there's more room to run within that sector. I guess more specifically, what are you looking at in order to determine that we could see more broadening and we could see more activity within? Is it a continuation almost of some of that weaker econ data that we have started to see?
Well, it's a combination of the top down and the bottom up. The bottom up's going to be there. I'm not just going to make some kind of shift into the defensive's cause. The earnings have to be there. Valuation certainly is there. And I think that if we continue to see strength and breakouts in some of these weaker names technically, that gets your attention. And then as you see flows start to develop in those areas, that's saying sentiment, has kind of shifted. So I think we just got to see a sustained period. And you're right. I mean, tonight is data. If Nvidia comes out and the earnings news kind of reinstills confidence, then, I think that we will see a more balanced, broader participation this year. We expect the market to be up 10%, and both camps could do well. I think it just depends on what the news flow is out of areas like Nvidia and the Mag 7. As long as the news is not devastating, they can still do well. And as long as the economy holds up and earnings in these other areas, they're very attractively priced. And I think you could just see a broadening in the market with some of these other stocks playing catch up. But it's a day-to-day kind of observation on what's going on.
So you mentioned your price target of 6,600 by year end, implying about a 10% move. And I hear you saying that there is still a bit of optimism to be squeezed out of the tech trade. But what gets us that 10% move to the upside? Again, you're saying this broadening, but you still like tech. What exactly does that 10% move to the upside look like? And how do you position to take advantage of that?
Well, first of all, it's a function of PE multiples and earnings, right? That's how you get to 6,600. So if you apply a 21.5 multiple to our expected earnings that you'll see as we move into 26 of a little north of 300, that's how you get 6,600. And then you have to go underneath the hood and see, well, how are you getting that earnings growth? And quite frankly, right now, consensus earnings when you look broadly across sectors, not just technology, but it's healthcare, consumer discretionary, finance, earnings growth looks good. So, you can argue about positioning, but when you just look at the aggregate index level, there's earnings support there. And it's predicated on about 2.5% earnings growth. The 10-year Treasury trading around 4.5%, and solid margins that hold up. And right now, there's no reason to think that that's not going to happen. And we may get wiggy day to day about the recent headlines on news coming out of the administration or speculation about what the Fed may do. But underneath the hood, you've got solid earnings growth broadly. And that's what you got to continue to track and see if we stay on course. And there is risk when you're trading at 21, 22 times. If profit margins stall, then you're going to get some hiccups. But right now, that's how you get to 6,600.